Well, for investors looking to increase their allocation to Australian real estate credit investments, the question is, how do you pick where to invest? Well, let's get into that. Cathy Houston is Managing Director at MA Financial. She joins us now. Cathy, good to see you.
Thank you so much.
So, private credit lenders increasing their footprint in Australia.
Absolutely, yes.
So what opportunities does that present?
Well, I think it's a great opportunity at the moment. I think private credit in general and also secured real estate credit is absolutely having a great time at the moment in terms of delivering really great returns, but still focusing on that capital preservation. So we're talking about first mortgage on property in Australia, and we're delivering returns of 9% plus. So it's a great return for that type of investment, but you really do have to think about who you're investing with.
All right, well then how do you make that decision? What do you need to look for?
Absolutely. Well, I think the first thing you need to do is understand what you want to invest in. So, and what are you investing in? What is the manager proposing to invest in? So, are they investing just in first mortgages, or do they have some mezzanine? There's so much difference between first mortgage and mezzanine. Mezzanine means that you're sitting behind somebody and you don't have that control over the loan. So if something goes wrong, you have to sit there passively. And so you really need to make sure that the product that you're looking at, understand, is it just first mortgages, or what proportion can they put in mezzanine? And if you don't know that, you need to be asking questions, and therefore you're looking at the transparency, you're looking at the information that product is providing you. And if it's a wholesale product, you can ask lots of questions of that fund manager before you actually invest. So it comes down to that transparency, that willingness to actually answer the questions, explain to you what you're investing in. So that transparency is very big. You should also be looking at the governance structure and the robustness of the platform that you're investing in.
I'm taking a look at some numbers. I think back in 2022, some 5% of financial assets made up of non-bank lenders. I mean, it's a small market, but is that growing though now?
Absolutely. And if you look at it on an international stage, then you can see that Australia compares, we've got such a small percentage of non-banks compared to our major banks, compared to what's in other countries. So I think there's consensus amongst both the major banks and the regulators and the non-bank industry that we have to grow our market share. It's good for the economy. It's good for that diversification. It's good to provide borrowers and investors with those options. So I definitely think that there's a lot more growth potential in the market for non-banks than for the private credit.
What about, I mean, how secure is that, particularly, I guess, when they're pledged against those real estate assets?
So again, that's why we're going back to thinking about what is the actual asset that you're investing in. So is it actually first mortgage? And to that point, it's really around looking at who the manager is and what sort of due diligence does that manager do before they invest. So you're really looking at the experience of the team that are doing the investing to actually understand whether they actually have the experience to look at the valuations. Because the first thing you're thinking about is a first mortgage. You've got to actually understand what it is that you're investing in and look through the valuation to look at the detail in there and really rigorously assess that. Look at the comparables, look at what the risk elements are. Is it bushfire prone? Is it flood prone? Really look and see what the approvals are on that property. And then it's also the fund itself. How is that being managed? How is the liquidity in that fund being managed? So how is the treasury on that being managed? What's the experience of the team in problem solving? So it's all those sort of factors that you need to think about when you think about who to invest with.
Where are the opportunities lies segment-wise, but perhaps beyond residential, for instance, office and retail? I mean, they remain under pressure, don't they?
They do, and I think that there as more activity happens in the market, then there'll be more confidence around the values on those assets. There's been quite a long period where there hasn't been a lot of activity, and therefore there's been uncertainty around where the values are in those assets and where the values may go to over a period of time. So, and that's why our focus has been more on residential, and our portfolio is actually heavily dominated by residential is because there is so many data points in residential, and we all know that there's a undersupply in the market. So we're
Just
feeling
a
pretty
bit,
confident
yeah.
about that. not that we think that the poor renters and people trying to get into the market is great, but as an investment choice, it's a good investment choice.
Well, in fact, you would expect that we hear more from that in tonight's budget too.
Absolutely.
Which may be further boon, I guess, in terms of that investment. So, Kathy, transparency obviously a key
Absolutely.
here.
Yes.
I mean, how important is that? You need to know exactly what's going on beneath the surface.
Absolutely. And you need to understand the organisation that you're investing with as well. So you need to know whether they're a robust organisation. So if it has the governance behind it as well, to be actually able to be doing the right thing for investors. So is it ASX listed? What sort of compliance do they have behind? So you really need to be asking questions around who you're investing with, who the people are, and again, as you just said, what you're investing in. So really understanding the types of products that the investment product has within its portfolio, or even where it may get to. So it may have something within its portfolio, but it may be able to increase the share of mezzanine to a high percentage. So if you're investing for the long term, you need to know what you're investing in.
What about those property valuations? How do you get a good sense of what that is?
So it's really around, it's both looking at what's in the valuation, but generally understanding the market. So understanding what's happening in the market and how those values. Evaluation is a backward-looking report. So it's based upon historical data. And what you really need to understand when you're investing, and when you're investing as a debt product, where you have an end period, a maturity where you need to be able to get repaid at that end maturity, you need to have an assessment of where that value might get to at that point in time. And again, as a debt product, we're always looking at downside risk. So I'm not so worried if it's going to shoot the lights out in terms of valuation. I'm worried if the value is going to deteriorate. So we need to understand what's happening in that market. How much more supply is going to come in that market? Do I have other data points that I can draw from to understand how that market might change over that term and beyond that term? So that's really what we're looking at.
And Kathy, what consideration do you need in regards to interest rates, given the prospect that interest rates will be cut eventually? It's a question of timing, though, isn't it?
I knew you were going to ask me about interest rates. My assessment has been that it will take some time before interest rates start to get cut. Because we're factoring in for downside risk, we actually factor in to have a little bit more of an increase because it may happen. And so we need to make sure that we're ready for that to happen. I think that they will get cut eventually, but I don't think it's necessarily going to be anything substantial. If you look at what historical interest rates are, or were, they used to be about 5%. I mean, the average has now come down because of the period that we had a very low interest rate, but there's still, if you look at a long-term average, you're still probably looking at around the 4% mark. So it's not like we're expecting interest rates to go back down to really low levels.